So we kick off this, the 56th weekly Friday show from Radio Free UK, with an update from the Leave.EU referendum campaign, presented by Alan Taylor-Shearer.
And here's the latest from Leave.EU. The Bank of England has claimed that £65 billion has been pulled out of the UK over the last 2 months due to the risk of Brexit. They say this is the fastest rate of withdrawal since the financial crisis. Certainly, such sums sound scary indeed, but does the claim actually hold water? Let's look at the performance of all the key asset classes to see if investors are really worried about Brexit. Firstly, currency. Against the US dollar, sterling is flat over the month and up 2 cents over 3 months. Against the euro, sterling is very marginally up over 1 month and very marginally down over 3. The quantum of change is frankly stable. This is not consistent with investors being concerned about Brexit. If they thought it an issue, sterling would have crashed. Secondly, the stock market. The FTSE 100 stood at 6,199 3 months ago. 1 month ago, it was 6,117. The current close was 6,286, some 1.4% higher than 3 months ago, and 2.8% higher than a month ago. This is hardly consistent with market panic that the Treasury would like you to believe. Thirdly, house prices. According to Halifax, average house prices to May 2016 rose 1.4% over the last 3 months and were some 9.2% higher than 12 months ago. If consumers were really concerned about post-Brexit mayhem, would house prices really continue to rise? Fourthly, the cost of borrowing is falling, not rising. If investors were really worried, borrowing costs would be rising, not falling. Thus, George Osborne's claims that Brexit will hit mortgage costs is almost certainly the converse of what will happen on Brexit. 12 months ago, the 5-year benchmark gilt, which is typically used to price mortgages, yielded 1.51%. 3 months ago, this had fallen to 0.88%, and today, 5-year gilts yield 0.75%. If there was a run on gilts due to Brexit fears, these rates would have risen, not fallen. No, on Brexit, rates are more likely to fall than rise. Pulling £65 billion sounds scary. However, global currency flows are truly enormous, and the vast majority of these flows have little or nothing to do with trade or investment. They are simply short-term speculation. Looking at the trends in real investment markets is far more illustrative of what is going on, and in terms of currency, the position is fairly stable. While looking at borrowing costs, property prices and stock market returns suggest consumers and investors are unfazed about the UK leaving the EU. And that's the latest from Leave.EU.